Gold didn't just break the $5,000 ceiling, it shattered it, hitting an intraday high of $5,111 per ounce. But perhaps even more shockingly, silver, well, it just decimated the psychological barrier of $100, trading near $110. We aren't just looking at a price spike. We are witnessing a historic repricing of the global monetary baseline.
It is certainly historic. I'll give you that. The velocity of this move is absolutely breathtaking. I mean, we are looking at a market where silver has gained 52% in just the first few weeks of January. But we have to ask the hard question here. Is this a rational response to the world we live in, or is this a moment of absolute euphoric madness?
And that is exactly the central question we are tackling today. I am the advocate, and I'll be arguing that these prices are a rational, albeit terrifying, response to a crumbling geopolitical framework. Specifically, the threat of 100% tariffs on Canada and the weaponization of the US dollar have forced the market's hand.
And I am the dissenter. I will be arguing that while the geopolitical risks are, well, they're non-zero, the market has completely detached from fundamentals. This move is being driven by retail FOMO, fear of missing out, short squeezes, and a misunderstanding of liquidity dynamics. The comparisons to a 1930s-style collapse are, in my view, historically inaccurate, and investors chasing this vertical line are likely walking straight into a trap.
Well, let's get right into it. I want to challenge this idea that this is a bubble. When gold crosses $5,100, it is not doing so in a vacuum. I argue this is a rebasing of value. We are witnessing a massive trust deficit. Investors and central banks are fleeing the US dollar not because they suddenly fell in love with the shiny yellow metal, but because the rules-based order we lived under since 1945 is shifting, and rapidly, to a power-based order.
Hold on. Trust deficit is a great buzzword, but let's be precise. What does that actually mean for the price of an asset?
It means the risk premium on holding fiat currency has exploded. Think of it this way. For 80 years, the US dollar was the global operating system. Everyone used it because the rules were clear. But the specific catalyst we saw this weekend, the breakdown of the USMCA and the active threat of 100% tariffs on Canada, our largest trading partner, that changes the code. When the US president suggests that no supply chain is safe, even with your closest ally, capital has nowhere to hide. You don't buy gold to get rich in this scenario. You buy it as fire insurance because the house is smoking.
Okay, I see the narrative you're building, and the headline numbers certainly support that anxiety. However, I look at the exact same chart, and I see a parabolic curve that defies gravity. Silver gaining over 50% in under a month isn't rebasing, it's panic. We have technical analysts noting that the, quote, rubber band has been stretched very tight. This price action reflects a massive fear premium that is pricing in the absolute worst-case scenario, total isolationism, which historically rarely materializes fully.
But isn't the fear justified?
Not to this extent. The market is ignoring that this is also a liquidity story. The Federal Reserve is expected to cut rates by, 150 basis points this year? That's cheap money flooding the system. That liquidity fuels asset inflation, not just in metals, but across the board. This feels less like the end of the Western world and more like a liquidity-fueled squeeze where too much money is chasing too few assets.
I'm not convinced by the liquidity-only argument. Cheap money usually flows into stocks or tech. This is flowing into hard assets. And that brings us to the elephant in the room, or rather, the elephant on the northern border. We need to talk about the tariff war. This weekend, the U.S. president referred to Canadian Prime Minister Mark Carney as Governor Carney on Truth Social.
It was certainly a choice of words that grabbed headlines.
It's more than a headline. It's a diplomatic insult. By calling him governor, the implication is that Canada is not a sovereign nation, but a vassal state, a 51st state, or a province. It delegitimizes the Canadian government's standing to negotiate. And the threat attached to it is a 100% tariff on all Canadian goods.
Look, it is aggressive rhetoric, I agree, but we have to separate the tweet from the policy.
But look at the justification. The U.S. is accusing Canada of being a drop-off port for Chinese goods. The claim is that because Carney negotiated a preliminary trade deal cutting tariffs on Chinese EVs, Canada is now a backdoor for China to bypass U.S. tariffs. The president is saying, if you let China in, we shut you out.
Right, but let's look at the reality of the USMCA, the US-Mexico-Canada Agreement. That's the trade deal that replaced NAFTA. It has very specific rules about non-market economies. Prime Minister Carney has explicitly stated Canada has no intention of a full free trade agreement with China that violates USMCA. He's playing by the book. The Governor Carney tweet is a negotiation tactic, maximum pressure. We saw this just last week with the threats against the European Union regarding Greenland.
And the markets panicked then, too.
Exactly. The president threatened massive tariffs on the EU, the market tanked, and then he walked it back when the EU paused the trade deal framework. It's a pattern. He yells fire, everyone runs, and then he sells them a fire extinguisher.
But the fire is real this time. We are talking about the most integrated supply chain in human history. Do you realize the complexity of the automotive sector? A single brake pad or transmission component might cross the US-Canada border 7 or 8 times before a car is finished. Raw steel up, stamped part down, assembly up, electronics down. If you impose a 100% tariff, that isn't just a tax, it is a blockade. It stops production cold.
I'm not denying the disruption would be severe.
Severe? It forces immediate violent inflation. If Ford and GM can't get parts from Ontario, they don't just pay more, they stop making cars. Investors are moving into gold because paper assets like stocks and bonds rely on a functioning economy. These tariffs threaten to break the machine entirely. That's why gold is 5,100. It's a bet against the supply chain.
I think you are catastrophizing a negotiation. Markets overreact to uncertainty. That's my point. Yes, estimates suggest tariffs could add, $3,000 to $6,400 per vehicle? That is painful. But companies are adaptable. Supply chains shift. To suggest that a negotiation spat on social media equals a 1930s depression scenario is a massive leap. The market is pricing in the total destruction of North American trade. If we get a watered-down deal, or if the 100% threat turns into a targeted 10% tariff on aluminum or EV specifically, that fear premium just evaporates. Gold could drop $500 in a week.
You're betting on cooler heads prevailing. I'm looking at the data, and the data says the big players aren't taking that chance. This brings me to the physical first nature of this rally. We need to explain what is happening between London and Shanghai, because this is technically fascinating and, frankly, terrifying.
You're referring to the arbitrage window.
Exactly. Usually, gold prices are roughly the same everywhere. If gold is cheaper in London than Shanghai, traders buy in London and sell in Shanghai to make a risk-free profit. That activity keeps prices aligned. But right now, Shanghai gold and silver premiums have exploded. They are trading more than $14 above London and New York spot prices. That is a massive gap. An arbitrage window so wide you could drive a truck through it. Yet it persists. Why?
Because the metal isn't moving fast enough.
Because the metal isn't there. You can't arbitrage the price if you can't get physical delivery of the bars to ship them to China. This proves the paper price on the COMEX, where people trade futures contracts that rarely result in delivery, is broken. The real price is being set by physical demand.
It is a massive divergence, I agree. But let's look at who is driving it. You assume it's all smart money.
It is sovereign buying. Central banks, China, Poland, India are buying record amounts projected at over 800 tons a year. They aren't speculating on whether the Fed cuts rates in March. They are diversifying away from the dollar because they see the weaponization of the currency. If the U.S. can threaten 100% tariffs on an ally like Canada or seize Russian assets, what does that mean for holding U.S. Treasury bonds? It means they're risky assets.
But look at the speculative positioning. Data shows that paper speculators on the COMEX, the hedge funds and money managers, were actually net selling while prices rose last week.
Which proves my point. The speculators were wrong. They tried to short the market thinking it was too high, and they got run over by physical buying.
I interpret that data completely differently. If the paper speculators, who, let's be honest, usually drive the price discovery in the short term, are selling into this rally, it suggests the smart money in the West lacks conviction at these all-time highs. They are cashing out. They are looking at $5,100 gold and saying, "Thank you very much, I'll take my profits." The fact that the price keeps rising despite speculators selling tells me this is now being driven by panic buying and retail FOMO.
Or it tells you that the Western paper market has lost control to the Eastern physical market.
Perhaps. But look at the retail metrics. Account openings at precious metals brokers have doubled in January. We're seeing classic chasing behavior. People hear gold 5,000 on the news and they buy because they think it's going to 10,000 next week. And regarding those bank forecasts, major banks like JP Morgan and Bank of America had price targets of around $5,000 to $6,000, but those were for year-end 2026. We are in January. The market has front-run the entire year's expected gains in 3 weeks. That is the definition of a bubble.
A bubble implies there is no substance, but the demand is structural. This connects directly to the economic structure we are facing, which I believe is a modern recurrence of the 1930s.
Here we go with the Great Depression comparison.
It's relevant. In 1930, the U.S. passed the Smoot-Hawley Tariff Act. They thought it would protect American jobs. Instead, it triggered a global trade war, exports collapsed, and the Great Depression deepened. Today, the weighted average tariff is heading toward 10 to 14%, levels we haven't seen since 1946. We are walking into stagflation. Tariffs raise the cost of goods, that's the inflation part. Simultaneously, they crush cross-border trade and efficiency, that's the stagnation part.
The 1930s comparison is popular and it sounds scary, but I just don't buy it. The monetary context is entirely different.
How so? Protectionism is protectionism.
In 1930, the U.S. was on a gold standard. The money supply was constrained by the amount of gold in the vault. When the economy contracted, the Fed couldn't just print money to grease the gears. That led to a deflationary spiral. Prices fell, wages fell, debt became impossible to pay. Today, we have a fiat system. We can and we will inject liquidity. The Fed is expected to cut rates. You mentioned the deficit. Yes, it's high, but that deficit spending also supports nominal GDP. This isn't a deflationary collapse. If anything, it's an inflationary boom.
But that is exactly my point. That is why gold is rising. You're right, they won't let it be a deflationary depression. They will print money to stop it. The Fed is trapped. Unlike in 1980 when Paul Volcker raised rates to 20% to fight inflation, we have $36 trillion in debt and $1.7 trillion in annual deficits. We have fiscal dominance. If the Fed raises rates to fight the inflation caused by these tariffs, the interest payments on the national debt would bankrupt the Treasury. They must cut rates to save the government's balance sheet, even if inflation is high. That guarantees the debasement of the dollar.
Debasement is a strong word.
It's the right word. If you print money to pay bills because you can't afford the interest, you are debasing the currency. That is why gold is at 5,100. If it's not just tariffs, it's the realization that the U.S. government has mathematically eliminated the possibility of defending the dollar's value.
I admit the debt levels are concerning, but the dollar collapse theory has been around for 40 years. Look at the FX markets. The dollar is actually softening, which helps U.S. exports. And compared to who? The euro? The yen? The U.S. economy is still outperforming its peers. The surge in metals, in my view, is a signal of too much liquidity, not a breakdown of the system. It's money looking for a home because the Fed has signaled they are going to ease. That supports asset prices, sure, but it doesn't mean the grocery store is going to stop having food or that the banking system is collapsing.
Let's pivot to silver specifically, because if gold is the fear trade, silver is the chaos trade. The move there is even more extreme. You called it a bubble, but I see a shortage. The gold-silver ratio has collapsed to roughly 46. That is a 15-year low.
For our listeners, explain why that ratio matters.
The gold-silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, it sits around 60 or 70. When it drops to 46, it means silver is outperforming gold massively. This isn't just speculation. Silver is the fuel of the new economy. You could not have the AI boom, data centers, or the green transition, solar panels, and electric vehicles without silver. It is the most conductive metal on Earth.
I agree the industrial story is compelling, but price acts as a rationing mechanism. At $110, you start looking for alternatives.
Supply. And now we have this drop-off port dispute threatening the flow of goods. If you are an industrial user, a solar manufacturer, or an electronics firm, and you see the U.S. threatening 100% tariffs and supply chain wars, you don't wait. You panic buy inventory. You secure physical metal at any price because you can't run your factory without it. That is why silver is at 110. It's an inventory squeeze in a fractured world.
That is a valid point on inventory hoarding, companies overordering to be safe. But that cuts both ways. A move from $30 to $110 in a year prices in absolute perfection. It assumes that the demand for solar panels and EVs will grow to the sky forever. But wait, if your stagflation thesis is correct and tariffs crush the global economy, who is buying the EVs?
What do you mean?
If we enter a recession because of these trade wars, consumers stop buying cars, they stop installing solar roofs. If the economy slows down, industrial demand for silver will fall off a cliff. Industrial metals get crushed in recessions. You can't have it both ways. You can't have a depression that destroys the economy and booming industrial demand for silver.
That's a fair challenge. It's the paradox of silver being both a monetary metal and an industrial metal. Though I would argue that in a crisis, the monetary demand, silver as poor man's gold, will override the industrial dip. People will buy it because they can't afford gold.
Maybe, but consider the volatility. Silver is notorious for this. It goes up the escalator and down the elevator shaft. A 50% drawdown from these levels would take us back to $55. That is still historically high, but it would wipe out anyone who bought this week. The fear premium is pricing in a total cessation of trade. If Prime Minister Carney and the president shake hands next week, or if the tariffs are watered down to a symbolic level, that premium evaporates instantly.
But do you really see them shaking hands? The Governor Carney comment suggests a level of personal animosity that isn't easily fixed. This is about national sovereignty for Canada and economic dominance for the U.S. Leaders don't just back down when they've been publicly insulted on the global stage.
Politics is theater, my friend. They need a deal. The U.S. auto industry cannot function without Canadian parts. The lobbyists in Detroit are likely screaming at the White House right now. That economic reality usually trumps, pun intended, the political bluster.
I suppose that depends on whether you believe we are still operating in a world where economic rationality drives decision-making. My argument is that we have left that world behind. We are in a world where ideology and power dynamics supersede economic efficiency. We are willing to break the supply chain to prove a point.
And that is where we fundamentally disagree. I believe capital markets eventually force rationality. When the stock market drops 20% because Ford can't make cars, the president will pick up the phone and call Prime Minister Carney.
We are nearing the end of our time. Let's try to synthesize this for our listeners.
I'll start. Look, $5,100 gold and $110 silver are incredible numbers. They are historic. But listeners need to distinguish between a bull market and a bubble. The geopolitical risks are real, but the market reaction feels euphoric and overextended. We are seeing signs of a blow-off top. The fear premium is too high. If the 100% Canada tariff doesn't happen, which I believe is likely, or if the Fed signals stability next week, precious metals will face a harsh correction. Don't mistake a liquidity party for the end of the world.
I appreciate that caution, but I see it differently. This isn't a price crisis. It is a trust crisis. As long as trade wars escalate to the point of threatening 100% tariffs on allies, and as long as the U.S. debt spiral continues, the move into hard assets is the only logical move for sovereigns and individuals. The old rules of the 60-40 portfolio, 60% stocks, 40% bonds, are broken because both rely on a stable system. We are witnessing the pricing of a new, more fractured world order. If you wait for the correction, you might find yourself holding paper currency that buys less and less every day.
A sobering thought. We will know a lot more very soon.
Indeed. The coming week's Federal Reserve meeting and the outcome of this unprecedented Canada-U.S. dispute will likely determine if $5,100 is the new floor or the temporary ceiling.
Thanks for listening.
Good night.